you had already guided in the previous quarter commentary about the pressure on the realizations that was there building up in Q3. That's quite visible, and therefore that has impacted the performance, but largely offset also by the higher than expected or best ever volumes for the India production. Now, putting all this together, what are the key highlights of the last quarter gone by?
Sure. Firstly, thanks, Nisha, for having me on the show. Yeah, it's been a tough quarter. In fact, in many ways, the realizations in India, at least in October and November, were the lowest in the last 5 years. So we really struggled, from a realization point of view. But I think the actions on safeguard, etc., has helped. And plus the sentiment has got better and better, and the domestic demand is also growing. So hence you've seen prices going up. But the highlights of last few quarters, and particularly last quarter, has been a strong operational performance. A lot of cost takeouts that we'd planned during the year, has happened across geographies. So we had guided that we'll take out about 11,500 crores of cost during the year across geographies, and we are on track for that. So the internal actions, additional volume, cost takeouts, etc., helped us in delivering the numbers better than the markets would suggest or the realizations would suggest. But I think we've hit the bottom as far as realizations is concerned, and things are picking up now.
But coking coal prices, that remain a cause of worry even in this particular quarter, Mr. Narendran. What is the outlook on the pressure points from raw material prices and therefore the realization outlook for Q4?
Yeah. So yes, coking coal prices have gone up by about $50 in the last 6 weeks or so. Coking coal is a bit illiquid as a market, so it's very vulnerable to specific events. It could be bad weather conditions in Australia or something else happening in some mine or the other. So that's why you see this kind of volatility. So yes, you're right. That will have an impact on the price outlook because coking coal costs are typically 30 to 40% of the cost for any steel maker. So if coking coal prices go up significantly, steel companies will try to pass on those costs to the customers. So while the actions in the last few weeks in India has brought domestic prices at import landed parity or slightly better, the pressures on coking coal costs will probably push prices up a bit more. So we'll wait and see how that plays out. So the guidance we've given on prices for Q4 compared to Q3 is about 2,200 rupees per ton higher in Q4 compared to Q3 for India.
Right. And how much of the volume that you have really shown and above 6 that for the first time that you have really recorded in the last quarter, is that going to be recurring and increasing? How much of it is built in because of the demand and how much because of the expansion in India?
It's largely both because, for us, we typically run all our capacities, at least in India, at 100%. So we don't... we are always able to sell what we produce, particularly in India. So I think 6 million is now what we will look as a minimum for every quarter in India because the Kalinganagar ramp-up has happened as we have planned. And for next year, we'll have the Ludhiana plant getting started because that should be ready in March. So that adds another 800,000 to our volume. So I think 6 million for India now looks like the minimum we would expect as a management team, internally. So I think, but this quarter, you will see the volumes better than Q3 by 500,000 tons, largely because in Netherlands, we'll be selling about 400,000 tons more than we did in Q3. So you will see a 500,000 ton delta increase in Q4 compared to Q3 on the volume front on a consolidated basis for Tata Steel.
Right. The losses coming in from the European operations, Mr. Narendran, have been the cause of concern, and that has also been a drag on your overall performance. Can you give us an outlook on the Q4 performance and the break-even scenario when it comes to the units in Europe?
Yeah. So I'd like to split the European operations into two. The Dutch operation, which traditionally has been strong, actually. It has never needed any support from India. It's always been able to take care of itself. We had a couple of bad years, maybe 3 years back and 2 years back. We've now come around. So a lot of the improvement that you see in the bottom line of Q3 compared to the Q3 of the previous year is because the Dutch business has actually done quite well compared to the Q3 of FY25. The FY26 Q3 has been much better, and we see them doing better going forward for two reasons. One is the internal actions, cost takeouts, production stability, etc. And two is the continent. In Europe, I'm separating out the continent from UK. The EU area has taken actions by reducing import quotas from 30 million to 15 million. The CBAM is in effect. A lot more investments happening on defense, infrastructure, etc. So we are more positive about the outlook for steel prices and steel consumption in Europe than we were in the past. That is one. UK is where the challenge is because as far as internal actions are concerned, anything that could be done has been done. We have already taken out 400 million pounds of fixed costs. Operationally also, we are running reasonably well. It's just that we've not had the policy support that we were seeking because unlike India or US or Europe, there's not been any actions on safeguard duties or quotas in UK. We expect that to happen soon. And once that happens, we'll have a more realistic and stable market in the UK, and we can then look at making ourselves EBITDA neutral, which was, I mean, we were originally hoping to get to EBITDA neutrality by the end of this financial year, but it more looks like next year post the actions that we're expecting the UK government to take.
Right. So regulatory, actions would be really aiding that particular break even, and that's why you've pushed the timeline also. But Mr. Narendran, obviously, for the Indian steel makers, coking coal has always been a cause of worry. In our recent conclave in the last week, after signing the US deal, Commerce Minister Piyush Goyal has specifically stated that we are opening newer markets for Indian steel producers so that there is more availability of cheaper coking coal so that we are not dependent on one or two geographies, and even supply chain constraints can be really lifted and can be eased. How do you see this particular move? And with EU FTA and US trade, whatever details are available, what is the impact on your company and the industry?
So, as you know, because we have a European footprint and a India footprint, there are multiple impacts of these deals between multiple geographies and countries, right? As far as coking coal is concerned, North America is coking coal, which we use in Netherlands, for instance. We don't use them much in India because Tata Steel uses a technology called stamp charging, which is more suited for the coals that we get out of Australia or the coals that we have in India. The US coals are not great for those facilities. So where we don't have stamp charging facilities, one of the coke ovens in the Bhushan plant that we acquired in Meramandali or in our Haldia coke making facility, where we use what are called top charge batteries, there we can bring some US coal. So I think what I understand is we bring in about 1 million tons of coking coal, which is not very much from the US. The US has a disadvantage of higher freight compared to Australia. But US is a good source for us for Netherlands. US is also a good source for some of our peers in India because they don't have stamp charge batteries. They use top charge batteries, and they could import more coking coal from the US if the economics are favorable. So that's a positive thing. As the minister said, you have more options now to source coking coal, which is an important input, and India doesn't have enough of it or of the right quality. As far as direct sales from India to US is concerned, not much steel goes directly because in the past we've always had trade actions whenever you sell a bit more steel than the domestic players like. So for us, the impact is more indirect because a lot of auto component exports happens to the US and we supply to the auto component manufacturers. So that way the trade deal is positive for us. For us, our exposure to the US as a steel market is more from Netherlands and UK because we sell about 10% of the steel we produce there. And so there we are looking at the EU-US trade deals. It's still at a 50% duty, so we have a disadvantage there and we are dealing with it.